Today, we're going to be comparing three of the sexiest high finance buy-side industries: venture capital, growth equity, and private equity. Let's first start off with the top firms in each industry. Starting off with venture capital, here are the top firms in alphabetical order. And while these firms are individually vastly different from one another, these are the marquee VC names to know. Next, here are the top growth equity players, and I've divided these into pure play and more classic VC and PE firms with growth arms, because many of these firms do almost all types of investing, so the line is very blurred, especially for growth. Also note that while TA Associates is one of the original growth equity players, they're not in here because now they really focus on buyouts. Last but not least, though the largest funds are not always the best to work at, here are the largest and most prestigious private equity firms. If you end up working at any of these firms you just saw in any of these industries, you can end your career there and you pretty much would be set for life as long as you keep getting promoted, unless you get bored or realize that there's more to life than making copious amounts of money. And if you're watching this video because you're interested, particularly in breaking into private equity, you're going to want to check out the PE Investing Certificate program being offered by Wall Street Prep and Wharton, which is where I got my MBA. This program is sponsored by top firms like Blackstone, Carlyle, and KKR. And over 8 weeks, you can learn at your own pace through this online course that's taught by Wharton professors, Wall Street Prep's PE program director, and real estate PE investors, including David Rubenstein, the founder of Carlyle, and Martin Brand, the head of North America PE at Blackstone, who will cover topics like the PE deal process, valuation, how to think like a private equity professional, and more. By completing the program, you also unlock access to the alumni member database, fireside chats with PE investors, and exclusive networking events with the world's top private equity recruiters. This program runs 3 times a year, and if you're interested in any of this, be sure to use my code rareliquid to get $300 off, and also sign up by the early registration deadline to get an additional $200 off. I'll be leaving information and links to all of this, plus an LBO model you can download completely for free in this video's description. All right, now next up, let's go into the investment criteria, aka what do investors really look for in each of these industries. First, in case you're super new to finance, investment professionals have access to huge pools of money called funds, and this money is used to buy either parts of or entire companies. Companies are kind of like human beings in that they are born, go through puberty and just grow really quickly, become adults, and then become really old and senile and need to be taken care of. And there are different investors that invest in the different parts of the corporate life cycle. VC firms invest in companies when they are babies from the seed to Series B fundraising rounds. Growth equity firms when they are in young adulthood from Series C to pre-IPO rounds. And private equity firms completely buy out companies when they are mature, functioning adults in their 40s. When it comes to investment type, while VC and growth equity firms take minority stakes, aka less than 50% of private companies, PE shops take majority controlling stakes in either private or public companies. After an investment, VC and growth equity firms can influence the company by taking one or a few seats on the board of directors, but PE firms are responsible for the entire company and investment, so this is a huge difference. In terms of financials, VC firms want to invest in companies that are seeing insane 100% plus growth year over year, but also can be pre-revenue with a great product and team. While there is no hard range, growth equity firms want to see somewhere between 20 to 40% revenue growth and at least a path to profitability, while PE firms may purchase companies even with negative growth up to 20% growth, but do require stable profits and cash flows. Private equity firms require this because a major part of their strategy is to purchase a company with up to 80% of debt, just as you would mortgage a house, and use the company's cash flows to pay off the debt. And you can learn more about this and what I'm talking about here in this video I made about private equity. Next, let's talk about what firms in these industries look for in their investments. VC investors look for a large TAM, or total addressable market, because this is the only way companies will be able to turn into unicorns or decacorns. They're also looking for insanely capable and driven teams who will run through brick walls and overcome intense obstacles, because successfully starting a business is one of the hardest things to do in the world. Lastly, they're looking for a great product or service that is uniquely differentiated from what's out there in the market. Growth equity investors come a bit later into the scene after a company has already been around a few years and has proven product market fit. These investors look for the quote-unquote right experienced management team, because oftentimes the team that founded the company may not be the right one to scale the company. So management changes are common as growth equity investors come into the picture. Lastly, growth equity investors are looking for positive unit economics, meaning that for each product or service sold, there is a path for more and more profitability, which means that as the company scales, cash flow will increase and truly make the company valuable. Private equity investors look for companies who have the potential to have strong market positions, even if they are a little bit past their primes. PE firms usually invest with a strong game plan of what they want to do with management, and while they would ideally like to stick with the existing team, they oftentimes replace some or the entire executive team. PE firms ensure that management teams are incentivized based on performance, and their job is to grow the company's revenue and expand margins to grow cash flow and pay off debt as quickly as possible until the company is sold. Next up, let's go into the risk and return characteristics of these three buy-side industries. First, let's talk about the drivers of return. In venture capital, investors look for companies with products and services that are so innovative that they can actually create new markets or expand existing ones. For example, there was no rideshare before Uber, and while social media had existed before with platforms like MySpace, Facebook really expanded the market and changed the game. And of course, there's no point in a huge market if you can't acquire any users or customers, so VCs will pay close attention to that as well. Since growth equity investors are looking at more established companies, they're looking for strong and quick organic growth, meaning not via acquisitions, though that can definitely be a part of a company's growth strategy. They're also looking for market leadership, which comes in the form of strong branding, where it seems like the company is the well-known cool kid on the block, with examples of some recent marquee growth deals being Stripe's $600 million round, ByteDance's $3 billion round, and Databricks' $1.6 billion round. In addition to all of this, investors are also looking for a positive trend in operating efficiency and profitability. Next, private equity investors can drive returns by deleveraging, aka paying off the debt that they purchased a company with, to increase their equity ownership, which ideally is also worth a lot more because of turnaround and growth strategies that were implemented to increase revenue growth and reduce costs, which result in a company that is much more efficient than when they bought it, which could justify a higher exit multiple and therefore valuation of the company when it's sold. For venture capital, honestly, the risks are endless, but I boiled them down to three. The first is market risk, which is the risk that the market doesn't expand and or the company is unable to gain considerable market share versus its competitors. Second is product risk, which refers to the potential issue that the company never reaches product market fit and maybe doesn't create something that the mass market wants. Third is obsolescence risk, which is that given markets and companies move so fast, the company isn't quick enough to foresee trends or isn't able to adapt and literally becomes obsolete and worth nothing, which, by the way, happens to the vast majority of venture-backed companies. Next, for growth equity investors, the first main risk is management. And remember, this is like when a company is going through puberty and has a ton of hormones. Companies in this stage can grow from 10 to 100 to 500 employees in 2 years. And so this puts a ton of stress on the founders and first employees, testing if they can step up to the plate or should be replaced. In lockstep with this is execution risk, in that the company may have large, lofty goals, but may not be able to turn them into reality. Companies in this stage aren't just focused on creating a great product, but have to dominate and ruthlessly destroy competition by expanding everywhere. This can lead to the burning of a lot of money and inefficient execution. This also leads to scaling risk, which relates to the company's ability to grow without running into problems. Everything in the company, such as its operations and infrastructure, will be stress tested, while externally, they'll still need to keep a growing number of customers happy while they fend off more competition as they enter new markets. For private equity investors, the first key risk is financial risk. Since PE firms are taking on so much debt to fund their investments, changes in interest rates by even 1 to 2 percentage points can greatly diminish returns, and the PE firms have to be a lot more careful with investing in growth. This leads to operational risk, in that it's very common for investments to go awry when things don't go according to plan, and or management just sucks maybe and aren't able to execute, leading to lower margins. And whereas in VC and sometimes in growth, you can experiment and kind of just burn cash, you don't have that flexibility in PE. Lastly, private equity shops are much more sensitive to macroeconomic risks, in that fluctuations in the economy can totally ruin your game plan, which is much more prominent in PE than VC and growth. Now, with all this risk, there must come reward. And imagine if you were investing in a person who was a baby versus a young adult versus a fully grown adult. Things are much more unpredictable in the baby, right? That's why venture capital investors are looking to invest small amounts of money ranging from $50,000 to $100 million and 10x or ideally more than 100x their investment after holding anywhere from 5 to over 10 years. It's very common for just 3 to 5 investments to make up for 100 investments that go to zero in a VC fund. So they're really swinging for the fences with each investment, or put another way, just spraying and praying. For growth equity, investors put in anywhere from $10 million to several billion dollars and are looking for a more modest 3 to 5x return with each investment over the course of 3 to 7 years in the hopes that the company will soon IPO or sell itself. And lastly, in private equity, you're investing anywhere from $10 million to several billions, and you're looking to 2 to 3x your money and ideally hit a 15 to 30% IRR after holding for 5 years. All right, so I know we went through a lot here already, so I wanted to give you an overview of all the key points that I went through so far in case you want to pause the video to review. And please note that I made a lot of generalizations. Things are always a lot more complex in the investing world in real life. If you made it this far, surprise, this is actually part 1 in a 2-part series. And in the next video, which will come out probably in a few weeks, I'll discuss how value is created, day-to-day responsibilities, what kind of financial modeling you do in these industries, and then hours and compensation. But that does wrap up this video. And before you leave, I wanted to let you know that I'm building out my own How to Get Into Investment Banking course and giving out 50% discounts for those who sign up early. You can check that out in this video's description. I also am selling my resume that got me into JP Morgan. You can check that out at rareliquidcareers.com. And in the next screen, you're gonna see a video of an LBO that I built out of a real transaction when Burger King was taken private. It was a $3.3 billion LBO. You can check that video out if you're interested. With that said, thank you guys all so much for watching. Hope to catch you all in the next video. Thanks guys, and peace out.